And our next guest says the crystal ball on the Fed's policy trajectory lies in the hands of the consumer. That conversation is next. Let's bring Michelle Schneider now, Chief Strategist at Market Gauge. Michelle, it's good to have you on. Let's talk Jerome Powell's speech last night. They're signaling that the Fed is not in a rush to cut rates and continue to be guided by the data, but also somewhat acknowledging projections issued by officials at the September meeting that we could see quarter-point rate cuts at the next two meetings. What do you read of his latest messaging? Anything stood out for you there?
Well, he has been incredibly smooth throughout most of the recent meetings in presenting a case without really being committal. So, yes, we think that we're going to see the inflation target come down. We don't need to see the labor market cool more. We did that big cut to get things started. We see more cuts, but we're data dependent. I mean, if you listen to all of that, it's exactly why the market initially was like, oh, wait a minute, that sounds more hawkish. And then, well, maybe not so much. And it went from down to a strong close, which, by the way, talk about statistics, September, which has been a horrible month for so many years, now closed in the green. This is a very strong bull market we have. So whatever he says, unless he says something really crazy, like, oh, we just see inflation going higher and we're going to have to force the rates back up, the market is just on a trajectory to rally at this point. That's what it seems like.
Right. And before we head into a little conversation about the market, let's talk about what you expect to see from the Fed in the last two meetings of this year.
Well, what's so interesting is the surprise, and you had just mentioned, was after the 50 basis point cut, yields actually rose instead of come down. And so we've seen the yield sort of fluctuate here, trying to find its sense of fair value. So we've been watching the long bonds in particular. We think that really holds a key. And what's interesting about the long bonds, which would be seen through, let's say, TLT is the ETF, which is a 20 plus year long bonds, is even though the yields have come up a little bit, the actual cycle, the business cycle of the long bonds has flipped from a higher for longer to now more of an expansion, which means eventually we think the yields will come back down, which of course supports the rate cuts, maybe at 0.25% for each time, but more frequently. And I don't see any reason why he'll do more than that. I just think at this point now the TLTs have shown that the worst in terms of higher for longer is over, and the future is definitely lower yields, maybe not back down to where we saw them in 2020, nor should we get there, but at least not nearly as abrasive to certain areas of the U.S. market as they have been over the last several years.
Yeah, I just want to turn our attention to the stock market now. You talked about this being a very strong bull market that we have, and that's despite our stocks struggling at multiple points this quarter, notably at the start of August and September. Do these gains have staying power as well? Because October is also seen as a volatile month, and perhaps even more so this year because we are approaching the U.S. elections just over a month. There is that U.S. port strike uncertainty as well.
Well, and that is always the proverbial wall of worry that the market seems to climb. And yes, every day there's the new du jour stress. Of course, the port strike being one tomorrow potentially. And as you said at the top before, about now things seem to be escalating in the Middle East. So essentially where we're at right now, yeah, we know that the SPY has done very well. The Dow Jones Industrial Average made a new high, all-time high last week. But you really want to see where the market's going to go. I think you have to look at two separate areas. Number one is you have to look at what we call the inside sectors of the U.S. market. So yes, growth stocks have had their day. They've leveled off here, which is fine. But you have to look at the small caps. You have to look at the retail sector. And of course, with the port strike, the transportation sector is going to be really important too. And they've been consolidating. Actually, if you look at the price from July to now, really, we've kind of sideways. We've had some gyrations up and down, but essentially we're flatlining near highs. So that tells me that unless there's something so disruptive The market is anticipating these lower rates, anticipating that whatever happens in the Middle East is not going to have a huge impact on inflation. And that's the second thing we'll get into. And that the consumer, regardless of the election or whatever the anticipation is for the next administration coming in, they're going to be supported with looser monetary policy and potential tax cuts. And they're continuing to spend because they have money in the bank still, even though the stats could be different. So that's where we're looking at. If those areas of the retail, the small caps, and the transportation break out over the levels that they have been basically consolidating at for the last 3 months to the upside, I think you just have to really basically say, regardless of what you hear, the price is telling you something different. Now let's walk into inflation a little bit, because what has really prevented inflation from peaking back its head is because oil prices have been, in the face of everything, relatively low. Now, I just read, by the way, that the U.S. did replenish some of its oil reserves, which is a good thing. But it does seem like the potential for prices to go higher in the oil market are still there. So we can take all of that good roseate information we just said about the market and say if oil prices start to shoot up, sort of like a 1979 type of situation where everybody was relaxed and then things started to go crazy again. The gold is certainly reflecting it. Silver is sitting there in wait. Obviously, with China opening up, we've had more demand for other metals like copper and iron ore. Then things could actually come to a screeching halt. But until all that happens, we're still looking more soft landing or potential stagflation at this point.
All right, Michelle, appreciate your insights. Many thanks for joining us, Michelle Schneider, Chief Strategist at Market Gauge.